Hello and welcome to Investing Confidential. It is Tuesday and we have animal spirits taking over here in March. You can't fight the Fed. I mean, this is what we've always talked about, and the reason that you just can't fight the Fed is the Fed is change. The Fed looks like it's going to change direction for now, anyway. The Fed is dictating everything. Powell, as we said, is a dove at heart. I can only guess that 50 basis points is gone. That he has two alternatives now: 25 basis points, talk dovish, or pause and talk dovish. Either of those scenarios, this bear market rally, which just began today, or it actually began Friday, or began yesterday, is going to continue. And it could be fairly significant as bear market rallies go. And in a few minutes, I'm going to tell you why it's only a bear market rally and why we're in for a real disaster if this continues. But first, let's talk about animal spirits. Okay, this means that investors no longer are afraid of the Fed, and now they're going to challenge the Fed. Okay, they're going to push the Fed really hard. Okay, what are the positives? Well, here we go. Take a look. Banks are well capitalized. So this sell-off that we had over the last few days was premature, and it didn't matter. Okay, it wasn't right. We talked about initially last week that this SVP, there was no banking crisis. This is an isolated incident, and it has become an isolated incident. Now, the government and the Fed are going to take, and the FDIC, they're going to wave a lot of flags saying they caused it, but there was no risk to the system. Okay, you could see here that banks are very well capitalized. There was no ever any risk to the system. Okay, now you have a second. The Fed, again, I don't just this data, who knows where it comes from, but okay, here it is. Fed survey of consumer expectations. Everybody thinks inflation has been tackled. It's over, right? This is the consensus now. Inflation is done. Okay. Third thing here, you have the S&P. Technically speaking, holding the 200-day average. This is very bullish. Okay, I'm a technical trader like everyone else. S&P holds the 200-day. If it breaks through it, significantly tomorrow, you got to ride this rally. Okay, it's going to keep going higher, and that's it. The Fed's dictating everything. Okay, except the reality. Okay, the reality is much different than what the markets are telling you. First, look at the movement the last couple of days in this 2-year bond, the yield in the 2-year bond. It is dramatic. Dramatic is not even a word that describes it. If you look at it in historical perspective, it's basically never been seen before. This kind of move in a 2-year bond. It's one of these 2, 3, 5, 10 sigma events. Okay, it can't hold, but it's very impressive. And again, it's never been seen before. What does that tell you? All it tells you is that the markets are illiquid. The U.S. Treasury, which is supposedly the most liquid instrument in the world, is illiquid. Okay, there's no liquidity in anything. That a 2-year bond could move like this in today's environment is insane. Okay, this is bad. It's not good, it's bad. But the real issue here is inflation. Okay, let's look at the Atlanta Fed. Now, I'm not a big fan of the Atlanta Fed because they're biased, but look, here's what they call sticky inflation. Okay, so you see here, they talk about sticky inflation as a weighted basket of items that change price relatively slowly. Okay, so the darker line is the headline inflation, and this other line, the red line, is what they call sticky. Now, sticky inflation, this is what you and I, okay, now they take out food and energy, okay, but if they put it back in, it would be worse. So ex food and energy, sticky inflation increased almost 7% annualized. Okay, this is greater than what we saw last month, was 6.6 annualized. Okay, so this basket of items that we all use, even ex food and energy, okay, is going higher, not lower. Okay, sticky inflation. And so this is not good. Okay, let's look at food. Okay, here is food. And, even though food prices, and this is what the data told you, food prices were easing, food away from home. Okay, this means restaurants, takeout, something that obviously people are doing, is spiking higher. So food at the supermarkets, prices are off, but takeout is spiking higher and restaurants are spiking higher. This is what we call sticky inflation, folks. Sometimes prices go down, some prices go up, and we're going to be in this 5.5%, 6% level for a very long period of time, maybe spiking above 6%, 6.5%. And we saw this before. Used cars were up, then used cars came down. Real estate is down, real estate is up. This is what you call monetary inflation at its worst, and we will continue to have this. And now, the final chart that should make you all very nervous and confirm that this is a bear market rally. Here's the Fed during the 70s. Okay, this is what we call Fed flip flop, meaning policy errors. Okay, we see that we see in the blue line that's inflation spiking, and we see where the Fed has cut rates prematurely. And they cut it in 1973, went down a little bit, boom, spiked up again pretty significantly. They cut it again in 74, boom. That was the key. Okay, but you have to go to the end of the 70s, okay, in terms of 19, through the beginning of the 80s, where a lot of policy errors were made. At the end of the day, this is why Carter in 1979 brought in Paul Volcker. Inflation was out of control. Okay, the Fed had made numerous policy errors, and what we're seeing now is a very similar type of, timeline. And if the Fed does what I think they're going to do, this is going to be the first, well, not the first, many policy errors, but during this inflation era, the first really policy era that they're going to have to backtrack. And when they backtrack, whatever bear market rally that we had is going to significantly be traced. Because remember, there's no earnings. This is an earnings deficit rally. Okay? The earnings growth is gone. We have massive layoffs. Meta just laid off thousands of people, and the experts who tell you that don't worry about the layoffs, they told you that a month ago, and the layoffs continue at rapid pace. Okay, recession is going to happen. The U.S. dollar, okay, the U.S. dollar is going to begin a long period of weakness. This is your opportunity, ladies and gentlemen. If you're an investor, you need to take advantage and look at assets that go up with dollar weakness. So if you're an investor, got dollar weakness, and you got a big bear market rally right in front of you, take advantage of it, but be very careful out there.